Casey Boland time. Casey's with Hanghold Capital Management. And Casey, you've been doing your homework. Of course, you do your homework every day. Taking a look at comparisons of the bond market and stock market over time. And you have found what?
Wow. Well, I saw this by Bill Gross. He's referred to as the bond king, and he's an expert in bonds, and he reflected over the last 40 years, which is the inception of the Barclays Capital U.S. Aggregate, or Lehman Index, it used to be called, since 1976. Investment-grade bond markets have provided conservative investors with almost a 7.5% compound return with remarkably little volatility.
That's nice. Now, prior to that, bonds weren't all that hot.
No, because interest rates were so much lower when you go back 40 years. I mean, during that period of time, bonds had a rate of return of only 2.7% per year. So you're talking close to a 5% difference in the interest rate environment. And today we've got very, very low interest rates. So there's concerns for investors. Their expectations, what they have for their portfolios, will probably be lower than what we've seen in the past recent 40 years.
Yeah, because you like a mix of stocks and bonds. 60-40 is common, you point to, and there is, obvious differences in what you would make today with that combination versus what you would have made 10 years ago.
That's right, because the 60-40 mix during the last 40 years, when you involve the S&P 500 in bonds, has averaged about 9.7% per year return. And then that prior 40-year period leading up to 1976, during that period, a 60-40 mix, again, 60 stocks, 40 bonds, it averaged right around 6.8%. So you've got a 3% per year difference during that time period. So as an investor, boy, because rates are so low now, you should expect returns are going to be lower for your portfolio. And you know what? You may need to take some action about that.
Yeah, like what? Just change up the ratio a bit.
It may be. So before you completely overhaul the portfolio, maybe you need to look and say, am I diversified beyond traditional U.S. stock and bond holdings? So do you have global diversification? Maybe you need to spend more. If returns are not going to be there, you may have to do a little bit more of the heavy lifting. You're going to have to also look at your spending habits and your future needs and what those should be. But, I think risk and return expectations are probably the biggest. Are your expectations realistic? And if you need higher returns, do you understand that those higher returns are going to require accepting more volatility? And these are the types of issues we address with our clients. And hopefully you're asking yourself these questions. Are you ready and positioned to make sure you have financial security in your eyesight down the road in retirement?